Hello and welcome to Business Television India. I'm Piyush Jain, and joining us on the Market Group today is Chakri Lokapriya, Chief Investment Officer and Managing Director at TCG Advisory Services. Mr. Lokapriya, welcome to the show. Now, from the last time when we discussed, and now markets actually, they've not done much. If you look in terms of the broader range, 10,000, 10,500, we have been actually moving within the range. But mid caps, small caps, and there are a host of other stocks again which have been outperforming here. So I won't ask you basically how the market is looking to you. But what I want to ask and what I think our viewers would like to know is there is plenty of money out there. Mutual fund flows, again, basically those have been touching new levels. You basically actually have been launching new funds. Again, you also have good liquidity here. So are you able to spot enough opportunities right now? Is that sort of level of comfort there with you? And that's what I'm trying to extrapolate here. Is the market basically providing enough opportunities? If that is there, then perhaps basically we are in safe hands and we can continue to actually see outperformance here.
Hello, hi there, and it's good to be back. And I think it's a great time to be investing in the markets. This is because if you look at the last 5 or 7 years, economic downturn in India in particular, of course, the globe has recovered in the last couple of years. US is doing extremely strong. EU is strong. Of course, UK has its problems. Yeah, against this backdrop, India, because of lack of some implementation of some policies, had led to a slowdown of the economy. All that has changed with the bank recapitalization program, as well as the Bharatmala announcement. Now, because of that, the trickle-down effect on various sectors, on one hand, strong export markets because of strong global flow, strong economies in the globe, will do well for the export markets, and domestic companies will benefit from this pickup. All of them need what is called a last mile funding or institutional placements. I think we'll see a lot of that happening in the next couple of years, and therefore earnings growth will be very strong. Recover to be very strong over the next couple of years.
Right, but do you think actually the question comes here is, almost every year for the last 5 years, actually we started with very high expectations and this silver hope that perhaps private capex is now actually going to turn around here. Again, in the second half, finally some signs have started emerging, but then again the word is divided right now. Some actually are saying that still private capex is going to happen only 2 years later. Some are saying that yes, some companies actually are looking for that. What's your own assessment in terms of growth capital requirements, in terms of the way companies are looking at their growth plans? What's your assessment for that part of the economy, or that part basically of the growth calculation here?
You're absolutely right. I think a lot of things we've been pushing out growth for the last 3 years now. Right now, what we're saying is we're not saying that capex will pick up. It's unlikely capex will pick up for the next 2 or 3 years. But a number of companies, mid-sized companies, even large ones, they have delayed their expansion plans. That is not capex. They're underutilized capacity utilizations, but their market expansion, their top line expansions, because of lack of capital at attractive rates or lack of capital in itself. Now, because with the increasing recovery in the global markets has put a tailwind, and also with these new announcements in India, has now made capital available. So these companies are looking for this last mile funding to expand their offerings.
So I understand basically you have recently launched the alternative investment fund, the AI fund, and there's significant sort of funding which you have raised. So what sort of companies actually you're targeting in terms of deployment of capital? The reason why I would be asking this question to you would be that perhaps that's the area where actually you're thinking that growth actually could be looking much better for the next 2, 3, 4 years. The recovery could be there. So what are the areas where you are targeting the deploying capital?
You know, while we look to invest across sectors, there are a few sectors which are looking extremely strong. One is export-related sectors. Export-related sectors will include right from textiles, chemicals, refining, petrochemical, downstream companies, plastic companies, polymer companies. That is on one hand. And on the other hand, domestic sectors such as banks, infrastructure, and all the services companies, because there is a trickle-down effect with the revival of manufacturing. Companies like Quest Corp, which provides outsourcing services, also benefit. So it will be those domestic sectors as well.
Right. And in particular, if I want to actually talk to you more about specific stocks also. So what are the top stocks, the top themes again which you'd be preferring, or you basically would be thinking that they actually would be looking to outperform?
If we look at this capital raising as a phenomenon which is going to happen over the next 2 or 3 years, for instance, just today, Punjab National Bank has announced a QIP. And over the next couple of days, you will see institutional placements from Union Bank of India, Canara Bank, name it. So this is the first step. And we will look to invest in these companies as well. Because the credit growth has been lacking because of lack of capital. Now, even before the government infusion, they're doing institutional placements, which is a sign of confidence coming back. Second, you have even Natco Pharma announcing an institutional placement. So it is not just limited to banking or infra as a sector, but increasingly we will see them coming across sectors.
I want to ask you a tough question here.
Yeah.
And the question would be, while Natco Pharma, if I look at the ROCE or the return on equity, in very simple words, that is like an outperformer. On the return on equity has been a wealth creator. So a deployment of capital in a QIP for that company perhaps is another sign that you actually are funding their future growth plans, positive for the stock. For PSU banks, again, the question comes here is that you don't know basically, are there more NPAs? There are no NPAs. And also, if actually they are looking for funds, there will be a dilution of equity. But after that dilution of equity, is the worst already over, or basically the stock price basically still seems to actually getting adjusted to the new adjusted book value? So what sort of visibility basically you're looking, or you would be actually looking at the PSU banks here?
No, that's a good, very good question. I think NPAs will continue to be high, at least for the next 1 or 2 few quarters. But what is now going to happen is we are going to see a full stop where companies are allowed, because of this thing, to make a resolution and to take a haircut on some of the loans. And so that portion which is an NPA is recognized, and the balance portion becomes a performing loan. This allows a bank to make provisions, move ahead, and start remaking loans. So while there is a degree of uncertainty, but given the turnaround, we think the upside is also significant.
Right, so basically the turnaround is what I think we are waiting for right now. But let's talk about some of the themes again, basically, which you like. One of the theme is the infra. Now, recently again, basically we conducted an event in which Gadkari ji again was being kind enough in terms of telling more about the opportunities for the companies here. And if I look in terms of the order prospects here, for the EPC companies in particular, the order book basically has been swelling and has been increasing very substantially. So is there something which you like in that space, perhaps as an outperformer for the next few quarters?
Bharatmala is a $103 billion program over the next few years. And order books are beginning to come back. Now, if you look at the book-to-bill ratios for all these companies, is actually marginally beginning to increase. So this gives you an indication that actually stalled contracts are now getting restarted. And for this, you need capital again. And you see some of the stronger companies like Ahluwalia, Construction, who are able to execute because their order book is strong and their balance sheet is also strong. On the other hand, you have companies like PNC Infra, whose earnings were weak, and also because of some of the stalled projects continuing to be stalled. Now, as that recovers or becomes unstalled and capital is infused, you will see a sustainable growth for the next 2 or 3 years.
I want to ask you one question. Both the companies, again, basically are mid caps or small caps. I think our viewers would be very interested in those companies. The last time we talked about a number of companies, again, those actually have done well. Ahluwalia contract, let's first start on that here. Promoters, basically, they have pledged almost 41% of their holding here. They have reduced their stake recently. And the number 3, again, if I look in terms of the multiples also, it's not looking expensive here. So what's your own assessment right now in terms of growth prospects? It's not a dividend-paying company. So what basically is going to work for this company?
If you look at the next 2 years, FY18 and FY19, its earnings growth will be well in excess of 25-30%, actually accelerating to higher than 30% in FY19. On the other hand, if you look at its PE or valuation, it's probably trading at about 16-17 times on FY19.
Right.
And then you have its order book, which is beginning to accelerate. So this gives a confidence for the promoter, for the owners of the company, not just Ahluwalia, of all these types of companies, to go ahead to actually raise to address their capital issues. And therefore, we think there is a significant upside in Ahluwalia constructions over the next couple of years.
Right. And is this actually more about a play on that sort of space versus Brigade again, which would be trading around 15, 16 times 1 year P? Is that a difference between the businesses actually where you're taking a call?
Brigade is more a
reality, more into reality. I'm just trying to ask you a very tricky question. Is more on the business, right? And then basically also on the company, the valuations.
Yeah, it's more on the business. And because if you look at Brigade, it's a good company, but you're sitting, real estate as a sector, as we know, is sitting a huge amount of unsold inventory of space, constructed space. Commercial is slightly better than residential, but both have their fair share of issues. So over the next couple of years, their first task is to sell the unsold inventory. Their valuations had fallen to way low levels reflecting these concerns. But now, with a return of confidence slowly, you'll begin to see a selling down of the inventory, which is good for the stocks.
Fair point. So infrastructure is very clearly is what actually you're liking and preferring here. Let's also talk about PNC Infra here. Now, market cap is almost 5,000 crores. And if I look in terms of PE, the trailing PE would be around 41 times. Delhi Bilcon would be again basically trading around 23 times. What do you like in PNC Infra? And do you also like Delhi Bilcon also? Because I'm just comparing in terms of valuation opportunity here.
Yes, indeed. I think for these companies at this point in the cycle, valuation is less important simply for the fact that earnings have been depressed over the last couple of years because of lack of stalled projects. PNC is a good example where a couple of their road projects are stalled because of lack of clearances. Now, this has not allowed them to redeploy their capital and not raise fresh capital as well. Now, as that clearances come and new orders come, we expect to see an acceleration of earnings.
But do you expect to see those clearances to come by?
The clearance now, if there's this whole new thrust on Bharatmala, then the government will need to do that extra bit to make those clearances happen.
Okay.
Now, even if those clearances continue to get delayed, the other fresh projects where there are no such issues will aid the growth of the company's earnings.
But one interesting question could be, is that if those clearances are not coming, there are still going to be a dent on the margins in terms of working capital, or in terms of very minor but still operating expenses here. Is that going to be a concern?
Absolutely right. If you look at the last 3-5 years in this country, there's been a huge amount of capital mismatch in companies borrowing working capital to fund long-term needs. And all of that kind has happened, which has increased their cost of doing business and therefore reduced their earnings per share growth. Now, while there is a good chance that this project can continue to get delayed, but this mismatch, addressing this mismatch, for which capital is now beginning to available. Mind you, nobody was willing to even fund these companies 2 years ago.
Right.
But now capital is beginning, so that is the big delta, and which is a self-fulfilling cycle. As that capital becomes available because of greater confidence, the companies also has the ability now to go and bid for new projects.
While actually you like PNC Infra, is there anything you like in addition to that? I'm just asking you companies here, like Delhi Bilcon again, it's a large company, 12,000 crore market cap, but trading at 23 times. ILFS Transport again, 2,500 crore market cap. It has its own share of problems, but then again trading at 16 times P. Is there anything else which you like, or basically these are the companies which actually stand out for you?
No, these are good companies, and in addition, the big daddy of all, the Larsen and Toubro. I think if you look at infra as a space, clearly you need to like L&T, and we think at the current levels it is an extremely attractive stock, simply because its earnings growth, again for the same reasons, will recover very strongly into FY19, and 20-25% of all order book in this country goes to L&T. So against this backdrop, L&T I think will do significantly well over the next 12 to 18 months.
But I have a question here, because again, a lot of investors would be looking at L&T. It's one of the last stocks which a lot of investors would be having in their portfolio. Are you actually betting on the IDPL division, which actually has toll projects and those infra projects here? Because there are two stories which are moving there. One is the infra projects, if they are able to win more sort of projects. Second is monetization of their non-core holdings now, as they say it. Because apart from that, the domestic order book basically is quite scattered, and they're not seeing that sort of strong momentum as per the second quarter management commentary here. So, what do you think basically? What now could be actually a good buzzing point for L&T?
I think it's what was the buzzing point in L&T for 3-4 years ago, I mean maybe 5 years ago, which was an acceleration of its order book across various businesses. Now, as the capital markets continue to recover, L&T and plus other companies in other sectors, I mean banks are selling out asset management divisions, life insurance divisions. So similarly, L&T will also look to divest some of its other businesses. But that will aid clearly to valuation. And moreover, the underlying core business is seeing an increase in order books, which will lead to the improvement in the valuations. And as more than valuations, the growth translating into valuation.
Another space which you like basically is like Time Technoplast, which has an exposure to the cylinders, LPG cylinders, and also packaging in terms of SL Pro Pack. Basically, why do you like this company? Let's start first with the Time Technoplast here. And also I've seen over the last 2 months there has been some sort of re-rating also coming from the brokerages, some sort of enthusiasm basically coming for this counter here. So what basically is working for this company?
Yeah, we have already invested in Time Technoplast. And we think the growth has continued to, we'll see growth continue over the next couple of years for a couple of different reasons. One of the strongest reasons is if you look at LPG, which is LPG connections is a very important task for the government and a mission. And LPGs are made of metals traditionally, which is now moving to composite materials made by Time Technoplast, which makes these LPG cylinders lighter, stronger, and less costly to transport from place A to place B. So, and that way, because of the hundreds of millions of households which need LPG, the growth potential is phenomenal. So that is not in question. So that from that perspective, the growth that is available for the company over the long term is very strong, and that is on Time Technoplast. And second, you were asking me on
SL Pro Pack, but before that, I want to ask you one question here. Yeah. Between Time Technoplast and Everest Canto cylinders, they could be having some similarity, could be catering to different customers. But how basically are those two positioned? Is there a particular reason for why actually you're preferring Time Technoplast? Because I know one factor that the risk from the Chinese imports, again, that basically has reduced drastically, because we heard recently from the EKC management, the Everest Canto management, that they actually are now again looking at Indian market as a growth market versus actually pushing more products into the Chinese market here. So is there any sort of preference between those two companies?
One, in terms of growth, is now available domestically. So you don't need to look, these companies don't need to look to the export markets. And second, in fact, exporting or vice versa, importing them adds freight cost, etc., therefore makes it more expensive. And now you have this catalyst of LPG connections, so which is driving. Now, in terms of Time Technoplast versus Everest Canto, it is a wider range company, Time Technoplast. It also makes crates, lots of road barriers, etc., all of which are connected to an economic revival.
More diversified.
More diversified. And therefore, that's why we like this better. Of course, Everest is also a good firm.
Okay. Fine. So Time Technoplast is something which you like. Also packaging, basically, and we have seen, and I'm linking to different sectors here. We have seen basically paper stocks doing well, logistics stocks doing well, packaging stocks again basically have been doing well. But there has been divergence between the packaging companies also in terms of stock price performance here. If I look at Uflex, trading around 9-10 times, SL Pro Pack, again, the more diversified one, basically around 25 times. So what is working for SL Pro Pack, and what's so distinctive about SL Pro Pack which you like?
One is clearly the breadth of reach of SL Pro Pack. Uflex is also a good firm. But SL Pro Pack is a far bigger company, far better technologies, and far wider reach, both domestic as well as export markets. And so this gives us access to the latest R&D trends in packaging. Now, one of the key successes of Patanjali has been in its packaging and innovative forms of inexpensive packaging which look good. And I think so that is the key for SL Pro Pack, where right from your Colgate toothpaste to various shampoos, all kinds of products, packaging is key, and these guys do a very good job and are a market leader.
What about the competition here? Like, is there any sort of price competition, any sort of sensitivity to weigh again the crude prices or crude derivatives would be moving up? Because we have seen when the crude prices were low, a lot of packaging stocks, they actually were outperforming. So any sort of concerns around there? And also, why there is such a large divergence between the valuations of different packaging companies? Because I assume the tailwinds should be common. There should be some sort of outperformance, some sort of premium. But why there is such a large divergence?
The divergence is explained in size. Now, SL Pro Pack has a very big market share globally. So its earnings diversity comes from India's growth as well as a recovering global growth. And there's a multiple premium that you pay for that kind of diversity. And yes, the other smaller companies are also will benefit from this uptick. Second, in terms of the demand and crude prices, yes, they are crude linked, but they don't move in lockstep and barrel with the crude prices. And now various forecasts say that crude is going to be range bound between that 60 to 65 kind of a mark. Around that price point, they do fine.
But do you believe, like, if I just look at return on equity, it has been almost 12% average for the last 3 years. Do you believe that perhaps next 2-3 years are going to be for this company for actually seeing an improvement in the ROE?
That's a very good question. I think the same story applies to corporate India as well. If you rewind back 10 years ago, ROE for India's corporates was about 27 or 28%. That has fallen down to about 12 or 13%.
Right.
This is for well-known reasons, which is underutilization of capacity, low demand, underutilized assets, and fixed costs not working well.
So do they have a low capacity utilization right now?
All these companies, yes, these companies are sitting at about 65% capacity.
There is ample room then.
So there is ample room. Now, as that increases, that will increase your ROE.
Which also means that they don't have to invest right now.
They don't have to invest.
It's about demand.
Absolutely. It's about demand, but they need that capital to get their capital structure right.
Right. And about another company, interesting in terms of petrochemicals. Chemicals, they have been doing good. No doubt about that. Over the last 3 years, almost industrial chemicals, in fact, agrochemicals also actually have been doing good here. You like one company basically, which is a smaller mid-cap here. What is that company, and also what's so unique about the company?
One is, of course, a company like IG Petrochemicals, a phthalic anhydride thing. This is a chemical which is used across industries, right from consumer, name it, in very different sectors. So that way the demand is comes from very diverse sources. Second, it's the product that they manufacture is in short supply, which means pricing will continue to be very good.
So supply is tight globally?
Supply is tight globally.
Okay.
And, so far some amount of the local demand was met by both importing the raw material as well as from the companies like IG Petro, Tirmalai, who supply this raw materials. Now, because of the tightness in the import market, it has led these guys to have better pricing.
Okay.
And I think that will continue for the next at least 1 or 2 years. And plus, they're expanding capacities in the right time. So, therefore, higher demand, better pricing is a perfect recipe for these stocks to continue to do well. They've done well already.
So, is it also like some sort of impact coming from? Was there some sort of capacity shutdowns in China, or you think there was structurally actually a very tight supply market here?
A combination of lots of things have happened. One is China, as you mentioned, is tightening up on various kinds of manufacturing facilities. B, when you had those storms and tornadoes in the US,
right,
that led to a certain amount of shutdown of capacities.
And those have not restarted fully.
And that have not restarted fully. And meanwhile, both export demand and domestic demand have picked up. So even once they come back, it leads to a higher demand.
Right. So basically, tailwinds are strong for this company here. So in terms of your own expectation, what sort of earnings growth you would be expecting from this company over the next 2-3 years?
I think over the next 2-3 years, this company should grow well in excess of 30% per year. And because for the reasons that we've just discussed. And the valuations are not expensive from that perspective if you look at growth.
Right. Again, I think those should be basically in line with what actually we were discussing about the chemical companies some time back also. Now that this company falls into the same category. And number of companies, basically sectors we discussed in our today's show here. And I will just say about some of the companies Mr. Lokapriya just commented about the PNC Infra, Ahluwalia Construction from the infrastructure sector here. Also Time Technoplast, which again comes from the LPG cylinder pack here. SL Pro Pack from the packaging. IG Petchem again from the Petchem sector, where actually he believes that both pricing and demand basically is on the side of the company here. And also most importantly is what you were saying, that it's a time for the next 1 or 2 years where the companies actually would be looking for funding for actually fulfilling their growth plans. So earnings growth perhaps is on the right track here, and I think markets should be pleased on basically what you're expecting in terms of earnings growth, in terms of funding plans, and also growth plans here. Thanks a lot, Mr. Lokapriya, for coming on the show today. And with that, it's a wrap on today's edition of Market Guru. From the entire team here, thank you for watching us.